Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. And welcome back to our weekly Market Insight broadcast, where we give you our perspective on the week's top news stories regarding the market, the economy, and your portfolio. So with me today again is Aaron Tuttle, our Chief Investment Officer. Welcome back, Aaron.
John, I'm glad to be here. We got another quarter in together.
Yes, in fact, we're going to talk about some of the calls we made with regards to this quarter and how they played out. So why don't we begin? We have, for example, the third wave that we were talking about that seemed to have manifested itself and now is going down.
So yes, the virus is with us, and we believe it's going to be seasonal. So once again, we'll see it in May to June timeframe in Texas and Florida, and that the cases will really be marginal relative to they were last year. You know, another thing that we talked about was central bank accommodation. Do you think that was an accurate call?
Yes, there was certainly a lot of money pumped in by the central banks this past quarter.
Yes. Another thing we had said, because we were putting this together prior to knowing the end of the election outcome, glad we don't have to go through that again, but we had said that if the Democrats were the party in power, that it'll be infrastructure spending.
And we're seeing that.
And there would be emphasis on the new Green Deal, or the Green Deal? I can't remember what they call it.
The New Green Deal.
Is that it? Did I get it right the first time? Okay,
right
New Green Deal. And then with diversity and inclusion and equity as a component of that as well. I think that was accurate. We'd said that populism would, though, continue to grow.
Yeah,
it's been really quiet here lately, but I think it is, underneath the hood, it's still growing within the U.S. And then on our domestic call, I think that's also been spot on. But I think if we were to make the call today, we would actually increase the GDP growth for the U.S.
So tell me why you think that is.
Just the amount of stimulus that is hitting and the reopening theme. I think we're going to see a very hot market, we'll see numbers for GDP that we haven't seen in a long time, if ever. That we will likely exceed China's growth, so that there's another thing. Whenever we looked at our international call, we had its international slightly ahead of the U.S. I think if we were doing that today, we would have the U.S. before. Now it's the first
Interestingly enough, Jamie Dimon from J.P. Morgan was saying that he thinks we're going to be entering into a Goldilocks period of time because of the fact that we have the coronavirus now settling down. People have a lot of cash on hand, and that we're going to see an economic boom that will be sustainable at least for some period.
We have been saying that we're going to have the roaring 20s, so that's in line with our view.
Yes, it is.
Now, we also said that we thought the dollar would weaken and the yuan would appreciate. So far, that has been the case. Actually, China just came out with their own digital currency. A lot of people are comparing it with Bitcoin. I don't think that's a good comparison. It is.
Do you think that we have the appetite for doing something like that?
I think central banks want to have that control. It gives them a lot more tools. I'm not advocating for these tools. One of the things would be that the yuan the digital yuan, is expiring. Well, the idea of money, I think, is supposed to be a place to hold value. But the idea is that you have to spend that or it's going to go away. So that gives them a lever to control velocity, which we talked about last week. That velocity is one of those components in the inflation equation. So this would cause inflation to happen. And we'll get into there's a lot of things here that I think we'll cover actually in our call, so I don't want to go too far on it. When we look at stocks, looking back, we actually, I forgot about this, anticipated the value rotation. And that we stated that tech would eventually regain its status as the growth story. We still fall in line with that. Obviously, it's been a tough quarter to be more growth heavy, and a lot of the taxable accounts, because there's taxes associated with those trades.
Right, so it was hard to make some of the trades, and so some of our taxable account portfolios are lagging a little bit just because of the fact that we're not realizing gains, right? Because we didn't want to have short-term gains that are taxed at a higher rate, but now that we're past that the short-term game period, we may see some changes in the portfolios, I would assume.
Yes, and many clients may be frustrated that here we have this statement that turned out true, but we didn't make changes to portfolios based on that statement. We did in the qualified accounts, but that's one of those things that just is frustrating because you can't make changes absent with the understanding of what tax impact would have.
Right, because we are managing the tax bill as well as the return. So if we look at it on an after-tax basis, there's still a head. It's just hard sometimes to realize that when you're just looking at a number in your client portal.
Banking also is something that we said would do well because we expected inflation to push up yields, which would help the banking industry. That has been, so far, has been true. And basic materials, especially if we had infrastructure spending. And then finally, we have the debt. We said that there would be a debt bubble at $30 trillion and growing quickly. I think that is an easy call, actually. Whenever we look back, it's not that was out of left field by any means.
We've been voicing our concerns about bonds and bond yields.
As much of a bubble as it is, we continue to say that it's not ready to pop yet. So I think we are pretty much on track with a lot of our predictions about 2021.
Very good. So you guys are doing a great job. So we do see that the cases of coronavirus are continuing to decline.
Yes.
But there's also the fact that in Texas that they had the announcement of the elimination of all the restrictions.
Right.
Yet they continue to have a decline, maybe a slight uptick, but nothing near what people thought would have happened.
Right. Well,
So-
some people had thought.
Or that some people thought.
Right.
Yes.
There are other people that are making the case that have been accurate with that, and that's one of the reasons that Texas and Florida have rescinded their restrictions. But this was a major theme this quarter, is kind of the reopening theme. That if we look back to the beginning of the year, we can see that there's been a big drop in the amount of cases, which has helped on the reopening. Businesses getting going. There's also the optimism of the COVID vaccine, whether it's Pfizer, Moderna, or even the Johnson & Johnson, having that vaccine, and a lot of people are getting vaccinated to help. But as you mentioned, not all areas are as concerned about the virus. If we look at this is a picture of the Ranger Stadium, very full for attendance, and this is before everyone is vaccinated. So different regions and different areas are responding differently, which actually allows differentiation, so you can find out what is actually working. It's not easy to distinguish what's working whenever it's just a monolith, right? You got to have different tests that you're running.
Right, that's the benefit of this, is that now we have some empirical data about what the difference is between the different methods that states are deciding on in terms of restrictions and lockdowns and reopenings.
Now, our belief is that seasonality, there will be an uptick in Texas a couple of months from now. But you can see that they are reopening. And if you look at the open table data, where you have reservations.
Right, that's kind of
Florida,
an interesting
Texas,
thing.
they're all back to where they were pre-pandemic.
So think
where
about
New
it,
York
this is
and California.
Pre-pandemic.
Yes.
So the reservations and open table are at the same level as it was before the pandemic. Right, that's a pretty strong indication.
Yeah, one of the things that we have been talking about is this move from a lot of the big urban areas to the suburban areas and kind of the blue state to red state, not necessarily because of politics, but because of policy and opportunity. So I would not be surprised to see those areas actually far surpass the reservations on different indicators, because there's a lot of people moving there.
So we also had a change of administration, and that's going to mean differences in terms of government spending. As you mentioned, we've got the infrastructure spend. How are they going to get that through?
They are likely to use reconciliation again. They did get a win with a parliamentarian saying they could do it a second time. It was the understanding that reconciliation was only for getting spending bills through one time a year. The parliamentarian ruled that they could do it as a reconciliation of the reconciliation, so that is going to allow them to make some changes. And then to fund that infrastructure bill, I think this is the bigger change.
Right, because rather than just having that funded through increasing the debt, now they want to find offsetting revenues through tax increases.
Right. So one of the areas is raising the federal income tax level. The Biden administration went wants to go back to a 39.6% marginal rate, which is going back to where the Bush tax cuts were.
I think the bigger issue, though, is the corporate tax rates. By the way, I read today that Jeff Bezos is okay with raising corporate taxes to 28%, but I think that, in all fairness, it's probably not going to impact him as it is everybody else.
Yeah, the company that really hasn't had much in earnings is okay with raising the corporate. Sure.
A little tongue-in-cheek there, but there is some truth to that and how that's going to impact growth if we do have significant tax increases.
Yes, so it's one of the things that whenever we hear about taxing people, especially wealthy people, we assume that they just sit on cash. But it's usually in stock, it's in companies, it's in infrastructure. It's not easy to pay taxes whenever it's all infrastructure of a company and human capital that can't easily be monetized. So that's always an issue whenever we're talking about raising taxes, because then the companies can't reinvest.
So how's that going to impact our planning with clients and how we invest and portfolio management and so on?
So looking at the different tax codes, we are starting to look at that, because one of them is an increased tax on capital gains. Anything over $1 million would be taxed as ordinary income. Now, this wouldn't apply to every client, but it is not. If you have a very large portfolio, it's not unheard of to have $1 million in capital gains tax.
Well, let's say somebody wants to sell their company. Now the gain is over $1 million and it's taxed at ordinary income.
Ordinary income.
Imagine what that would do to valuations and those types of things.
There are products that would help offset this. So if we got into an area where capital gains were taxed as income, well, why wouldn't we look at a variable annuity to continue to defer those gains? Because there really isn't a difference anymore with keeping the equity for capital gains treatment versus income gain tax treatment. So then the tax shelter of a variable annuity would all of a sudden make them more attractive.
Right,
obviously, it's going to be...
You got costs such as the expense or the mortality, but when you look at that under the new tax bill, that'll be a minor differential.
And there are policies that are out there that keep the mortality and expenses very low, and if the tax cost goes up, then that may tilt in favor of having variable annuities for at least some of that, and those are areas that we could be more actively trading.
Maybe more important to have that just from a tax diversification standpoint.
Absolutely. And then we look at taxing unrealized capital gains at death. So right now you get a step up in basis. It makes estate planning a lot easier, and then you will pay an estate tax. Well, if they're all going to be taxed as income as well, that's going to require a lot of cash at death. So this is something that you're familiar with on how to deal with it, is you use life insurance if the tax code stays the same, because you can get the premium or the death benefit income tax free and use that to help pay, so you don't have to liquidate the entire business just trying to pay the taxes, and basically remove the business from existence to pay Uncle Sam what they are requiring. Also, there is a proposal for the increase in payroll taxes. You would get a kind of a window over $144,000. You wouldn't pay payroll tax, but once you passed $400,000, you would then begin to pay Social Security tax as well. So that's on the docket, as well as just boosting the federal estate tax. So you would still have the capital gains tax, but now you don't have as much pass-through, which, once again, a life insurance product would help us deal with these problems. And then just raising taxes on corporations. There's even talk of a minimum global tax. I have a response whenever people say that, well, we need a minimum tax. We already do. It's 0%. They don't always like that response. But there is a minimum, but it's talking about how do you set it where you can't have tax havens and tax shelters. Now, what countries are going to get on board with this? The EU is in favor of this, but there are countries like Ireland that have used the tax code to really help them be more competitive. So there's a lot to work out there. And then you can be concerned because of game theory. There'll be countries that figure out how to game that as well.
What is our opinion in terms of the impact that this would have on the market, the economy?
So it depends on how the tax is structured. So markets actually would likely increase if you increase taxes, and that seems odd. They would be less efficient, but if you have to pay a capital gains tax, and that capital gains is an income tax, the cost of you selling a company is going to increase. Now, if the costs increase, you're less likely to do that. So people will hold companies even though they may not like the prospect for the company. The tax cost is so prohibitive on the trade, they don't actually put those shares to market. That means that there are less shares to be traded on the market, so that reduces the supply of those shares as tradable. Everything trades on margin, so then you would have people still seeking to buy those companies with fewer shares, and that actually puts pressure on the stock price. We saw it in the 1920s. There was an expansionary monetary policy like today, and they also had raised taxes. Remember, the income tax just came in 1913, and you had a less efficient market, and people were not trading the shares because then they would have to pay gains on those.
So that seems to be an initial reaction, but then of course, as in the 20s, we then followed that with the Depression. So would there be some type of similar path, do you think?
If we continue to, history doesn't repeat itself, but it often rhymes. So yes, if we were to continue to implement similar policies as the 1920s, including monetary policy, tax policy, trying to keep prices, whether that's labor prices or stock prices, elevated, at some point something breaks because you're not allowing the system to balance itself out. So in the 30s, that was a break in the market price, and then they compounded the Depression by making it great with a lot of the other policies that they brought forward, which there has been criticism of the way that the U.S. government and the Fed dealt with the situation, and it comes from both sides of the aisle. Economists that follow a Keynesian approach, economists that follow a monetarist approach. It was central banks were still new, so there was a lot to be learned. So there's criticism on both ends. But that's beyond this call today.
Yeah, but I think that the important thing is that, so we do see this Roaring '20s and potential. Yes. Market collapse at some point, but we are also well aware of it and know the solutions to make sure that our clients remain financially self-reliant. So we will be talking about that in future discussions.
So another thing that we saw this quarter was the infrastructure spend and where that $2 trillion. Now this is the first edition. There's supposed to be a second stimulus bill that goes through. Within the current one, they have $621 billion towards infrastructure, specifically the new green energy type of deals. So electric vehicles are very much supported in this bill. Quality life at home, $650 billion, also trying to restructure things to be more green or more efficient in energy. Then there's another $400 billion for elderly and people with disabilities, as well as $300 billion for infrastructure, research and development and manufacturing.
What type of impact is this going to have on the national debt versus the GDP as we look forward?
All of this spending is really starting to show up and concern. So this blue line is showing the national debt. So it continues to go up. It's actually a hockey stick here over the last year. And then we look at GDP, the red number, we can see that the debt is far outpacing GDP. Now, one issue is that GDP is supposed to come out. We talked about earlier how we expected the growth of GDP. So these numbers, you got to really pay attention to the relationship to each other because of inflation. But this is certainly causing people to have inflation fears and inflation concerns. And we can see that if we look back at indexes.
Where is that being reflected right now? How do we know that it's there?
Well, one, we know it's there because people are no longer saying that we won't have inflation, right?
Right.
They're saying that it won't be transitory, that it won't continue and be persistent. It's just a one-time bump. And who ends up being correct, we're not sure, but we already see the signs of inflation. And this image on the left is just this quarter, and it's looking at several of the U.S. stock market indexes versus several commodity indexes. And then we're using the Dow Jones Industrial Average to be the benchmark. So if it's flat, it's still up for the year. It's just looking at comparison. So we can see commodities for the quarter have significantly outpaced the stock market indexes. And if we look back 200 days, almost a year's time frame, we can also see a similar thing where everything is based off the Dow Jones Industrial Average. The NASDAQ was up more than 9% above the Dow, which is impressive, but it's nothing compared to the energy index, which is up 20% over the Dow.
Right, so you would expect that the real assets, right, commodities are going to be the first place you're going to see inflation coming about.
Well, especially since a lot of this is infrastructure spend, that takes a lot of commodity use. So one of the things that we have is what is known as a crowding out effect. So the government is now getting into the commodities market because roads take a lot of commodities to build, and they're now competing for these commodities, driving the price up. At the same time, if they're implementing taxes where they're going to increase the cost of running a business and really the ability to retain earnings and reinvest those in the businesses are not able to really position themselves to continue to be more productive. That's not to say that this will not have any production or GDP will not go up. What it's saying is the government is starting to decide and have more of a tilt on what the market is deeming productive.
So if I was to kind of summarize it, it's almost as if you have two consumers. One consumer is us.
Yes.
The other consumer is the government.
Yes.
And when the government now comes and says, well, we're going to spend this much money on things that take commodity usage, that's now competing with us because we were using those at a certain rate. And so you're increasing the demand for that same thing that we're looking for. So our prices are going to be going up.
Yes, and then we're also going to take part of your money that you would have spent elsewhere, and we're going to use that to continue to buy what we think should be bought.
So that's going to make it even harder for me to buy the things that I want.
It can, yes, it can. And now, let's say that they were building roads and we didn't have roads. It may be that the economy actually is more productive by taking those resources and investing them in production that actually expands the ability for the economy to grow. But once again, it's the government making the decisions, not private enterprise. Historically, governments don't make as good of decisions as companies. That being said, the roads are very needed, right?
What are the inflation expectations then?
So we are seeing inflation expectations in rising yields. They're at between 3 and 3.2%. Now, we've been higher in 2014, and those inflation expectations didn't show up. But the inflation is not something that the government isn't aware of. It's actually something that they are pursuing as a policy. So that's another thing that we're seeing here in this quarter as a theme.
Explain this slide here.
So this takes a little bit of unpacking. So if we look back at the GDP and we look at the national debt and we just put a ratio, how much as a percentage is GDP over debt? So then we can start to say, we can make comparisons with 1950 to, let's say now, to say, well, what is the debt load relative to the ability to pay it back? And we can see that we have been at similar ratios. That's the blue line. So before 1950, or coming out of World War II, we were at 110%. We're certainly higher now at 140%, but we haven't seen the increase in GDP yet to help bring that down. And if we then compare that to the inflation over that time period, we can see that at 110%, all the way down to the 1980s, we were on a downward slope. So the debt was going down relative to GDP. And that's because inflation was high, so it was deteriorating the value of the debt relative to GDP. And that is the goal of the government, to get inflation high, to make the debt more manageable by paying it back with cheaper dollars. It is a risky game to play.
Right, so let's just hope that they get that right. But how is that being reflected now in the bond market?
Right, so these inflation expectations is not just consumer prices. Bonds are future cash flow. And if that cash is going to be worth less, that was the whole goal of the government, is trying to make the debt cheaper because you're basically making dollars less valuable in the future. Well, we can see that if we're worried about a concern or a correction in the market, and we have that concern, it's not been a good strategy to go to bonds. This is why we continue to say favor equities over fixed income when the government's policy is to deliberately cause inflation. So this was actually the worst quarter in over 40 years for bonds, and the places that were hit hard were the ones that are considered or deemed the safest. So treasuries were the ones that sold off the most within the bond market.
One of the good things that we've been able to do is actually to stay ahead on the bond in front of the benchmark. So we have been able to do better there. But it's still a very difficult asset class to manage at this point.
So, and the only thing that was up in bond markets for the quarter or had a positive return was high yield debt, and that tends to be more equity correlated.
Right.
So that's the only. So that's kind of an equity-like bond. Everything else was significantly negative to the point that if you're in long-term bonds, you actually are in a bear market, or I'm sorry, a technical correction for the quarter.
So which equities were hurt by this move?
So this is another area that we've talked about, and we felt this quarter, especially in the taxable side, we've talked about long duration. Long duration is not just a concept in fixed income, it's a concept in stocks. And stocks that are long duration tend to be growth, or really specifically technology right now. And that has shown up. So if we look at large cap growth, it was down negative 0.73. Where if we go down to small cap growth, it was down negative 4.2. Go to the value side's up 10%, while small cap value is up 21%. So those are and that's all just a reflection of the movement in interest rates showing up in equity. Now, negative 0.73 is rough and it's a negative return, but let's go back to bonds, right? The even less, what's considered less risky at negative 11. So you can see that you want to favor equities. Now we have a big position of growth. The reason is, let's look at the one-year return. Growth was up 55%, while value was up at 46. Look at 3 years, up 21% versus 10 compounded. That is a significant difference over a 3-year time frame.
Right. I mean, all we're looking at is at a short-term differential, because we know that over time these things even out and we're ahead overall.
Right. And so this value rotation, which is benefiting from rising rates, they tend to also be commodities, so they can better push off the increases to their consumers. And we have the reopening theme. These are all themes that have made a really good quarter for these really unloved assets over the last several years. So we did make some changes in qualified accounts to try to capture that. But that's what's going on underneath the hood. And then if we look at the different sectors, we can continue to see that basic materials for the quarter, as well as financial services, were all up strong. Industrials, infrastructure, and then look at energy, up 30%. So that's the reopening theme, plus the interest rate and the inflation expectations, all helping these areas. Now, if you go down 1 year, it's back to that growth story.
So if we're looking at our themes, what's changed, what hasn't changed?
We're wondering how long the value rotation is going to last. So the last couple of days, we've made up some ground against our benchmark because we've lagged with the growth, but it seems that the market is now, especially as the quarter ends, they're starting to transition, rebalance back into the growth side, because long term, the growth story is the growth story. So value still has a lot of headwinds, where it seems automation technology is really where a lot of the growth in the economy is going to be, not some of the older industry. Let's take energy, for example. If that solar power really becomes a thing that we had talked about a couple of calls ago, that's going to put significant headwinds for fossil fuel energy providers.
Yes.
So that's where we are, and if we look at our themes, there's really no change. We continue to go into these in detail. We hope next week you're out again. So Chris and I are going to spend some time on why we favor equities over fixed income to kind of really hash out that investment theme. When we look at the market on price points, we've made new highs.
New highs once again.
Yes, so despite having a quarter where technology was not adding to, that value is starting to really help push. And now this growth rotation, where both of them are moving up nicely, we're making new highs. We continue to see a lot of support below. It would be healthy to have a correction here. I don't think we're going to have a correction with another $2.2 trillion in spending that's coming up. If that if there's faith lost in the ability to get the infrastructure bill, that might be the catalyst to get us correction.
Yes.
We would still think that that was a buying opportunity, though, especially if we have
Absolutely.
a correction. That's probably going to expedite any stimulus.
Yes.
Then, if we
what
look
about
at
our relative strength this past week?
so small cap value still remains high. Now this is a more longer term view. We're starting to see some movement on a large growth, and we may make some changes in the portfolio if that continues to persist. It's good to see the S&P 500 moving up. One of the things that's been unusual through this whole thing, because we have seen inflation, is gold continues to be very low. And if our theme is correct, that's probably more of a buying opportunity long term, but we don't know when that trend will eventually settle in.
Exactly.
So there are things called value traps where it's a great value and it continues to be a better value. If your theme is right long term,
buy low,
you
and
continue
sell
to buy
lower.
lower, buy lower, buy lower.
lower.
But it's hard to do.
Well, that's great. Well, that's all the time that we have for today. So that's a great recap of the quarter, and we look forward to having you back next week. I won't be here next week, but
We
Chris
look
will
forward to not having you here next week.
I'm sure that'll be the case. But once again, our goal with these broadcasts is to give our listeners our perspective based upon data, analysis, and economic theory on the market, the economy, their portfolios, so they can be better informed in making decisions about their money. But we don't want to be kept a secret. How can we become better known out there for our listeners?
Right below us,
help us?
Right below us is an arrow. So click that arrow and share it with your friends so that they can also get this. And it would be, we do see a lot of changes. So we're trying to give people actionable advice so they can make informed decisions and really help protect their portfolio and make sure that they become and remain financially self-reliant.
And we have been getting great feedback from listeners as they join us, and so if we can increase our subscription, we do feel that this is getting a lot of value to those who do want to log in. So.
And if you're watching on YouTube right now and you're not subscribed, please click that subscribe button so that you never miss an update, whether it's a weekly market insight that we're doing or the daily 3x3.
So thanks again for joining us today, and we look forward to having you back next week.